Today, we are digging into a pretty explosive report from Muddy Waters Research. It asks a really pointed question about the fintech company SoFi, and it frames it in a pretty provocative way. Okay, so let's just jump right in. This quote right here is the heart of their entire argument. What the report is alleging is that SoFi isn't what it seems, that it's not a business with healthy organic growth. Instead, they call it a financial engineering treadmill, basically a machine that has to use all sorts of complex accounting just to keep running in place. And this visual from the report, wow, it really paints a picture of that treadmill metaphor. They lay it out like a control panel. On the left, you've got the speed controls, things like the default rates and discount rates. The report claims these are the levers that get tweaked and adjusted, all to hit that one specific compensation goal you see on the right. And hitting that goal is what pumps up the big number at the top, the reported EBITDA. And all of that leads to this, the single most shocking number in the entire report. Muddy Waters claims that after they adjust those financial levers back to what they think is reality, SoFi's 2025 Adjusted EBITDA is overstated by about 90%. So a 90% overstatement, I mean, that's a massive claim, right? The big question is, how on earth could a number that big even be possible? Well, the report lays out a few key arguments, and we're going to walk through them one by one. All right, so the first piece of the puzzle, according to Muddy Waters, has to do with SoFi's personal loans. Specifically, the rate at which those loans go bad and have to be written off the books. And this slide right here shows you the huge gap they're pointing to. SoFi reported a charge-off rate of 2.89%, but the report argues the real rate is more than double that, somewhere around 6.1%. And according to them, using that lower number in their models creates hundreds of millions in what they call unwarranted gains. So how could this be happening? Well, the report alleges two main tricks are at play here. First, the idea that SoFi sells off loans that are about to go bad just days before they would officially have to be marked as a loss. And second, something they call off-balance sheet parking, which is basically moving bad loans into other companies so the losses don't show up on SoFi's main financial statements. Okay, so that's the personal loans. Now let's move on to the second major claim, which zeroes in on SoFi's student loan business and what the report calls inventing paper profits. Now, this gets a little bit into the weeds of finance, but stick with me because it's super important. A discount rate helps you figure out what future money is worth today. The lower the rate, the higher the value you can book right now. The report's allegation is that SoFi used a discount rate for its student loans that was even lower than the rate you'd get on a 10-year U.S. Treasury bond, which is, considered one of the safest investments on planet Earth. And this chart just lays it all out, plain as day. You can see SoFi's discount rate at 3.89%, while the risk-free Treasury was higher at 4.16%. The report is basically saying SoFi is valuing its student loans as being less risky than the debt of the U.S. government, and they claim this is used to generate huge upfront gains on paper. All right, piece number 3 of this puzzle, according to the report, is a program that it claims creates a kind of artificial market for SoFi's own assets. Okay, so take a look at this diagram from the report. It looks complicated, but the idea is actually pretty simple, if a little wild. The report alleges SoFi lends money at a super low rate, like 5%, to a buyer. And then that buyer takes the money they just borrowed from SoFi and uses it to buy a bunch of SoFi's own loans. Let me put it another way, because this is a great analogy. The report is basically arguing it's like you lending someone money to buy your used car for way more than it's worth, and then you turn around and tell everyone, see, this sale proves that all my cars are worth this much. It's about creating a paper trail. And all of this, it's all building up to what is arguably the most dramatic part of the entire report. It involves an inquiry from the SEC and what Muddy Waters claims is over $300 million in missing debt. So the story, at least as the report tells it, kicks off right here. Back in September 2024, the SEC sends a letter to SoFi. They've noticed that these senior secured loans, the same ones we were just talking about, have been growing like crazy, and they want to know more. And then look what happens. Just look at this chart. The vertical line is when the SEC sends that letter. The balance of these loans had been climbing and climbing. And then, bam, it just falls off a cliff. The report points out that over $900 million worth of these loans were gotten rid of in just the last few days of that quarter. Okay, so where's the missing money? This is where it gets really interesting. SoFi apparently called a $312 million chunk of that disposal a sale. But the report points to these public financial documents, called UCC filings, and says, not so fast. They argue the paperwork shows it wasn't a sale at all. It shows SoFi just used the loans as collateral to borrow $312 million from JP Morgan, debt that Muddy Waters says it just can't find on SoFi's books. So, after laying out all of these different threads, what's the big picture here? According to the report, it all comes down to who's benefiting from this treadmill and who's paying the price. So here's the alleged game plan, step by step. The financial engineering inflates the EBITDA number. That bigger number helps management hit their bonus targets. But, the report argues, these maneuvers cost money, and they require the company to constantly issue new stock. And that new stock dilutes the value for existing shareholders. And to really drive the point home, the report makes one last really sharp claim. It says that even though official filings state the CEO hasn't sold any stock, management has found ways to lock in about $58 million in stock gains anyway, using complex financial instruments. And so, in the end, we're left with a fundamental question that this whole report is built around. It describes a system that, in their view, has to keep getting more and more complex just to keep going. And it leaves you with this final thought. If a business really is a treadmill, what happens when it finally runs out of road?